Another month have passed, and now we are entering the second half of 2023. Well, time really does fly. Lots of things have happened during these past 6 months. There's a lot of dramas in the economy, the world, and the stock market as well. So, how have stock markets performed over the past 6 months? Let's have a look. As usual, let's look at the index that I'm particularly interested in. Beginning with the S&P 500, on a year-to-date basis, the S&P 500 is up 16%. Singapore Straits Times Index is down 1%. Hong Kong Hang Seng Index is down 6%. And at home, the FB and KLCI is down 6.6%. So most of the markets are down except for the US. So similarly, as always said, the US is still the best market to invest in, but that doesn't mean that you should invest right now. Let's have a look at the charts to know more of how the movements are like. Beginning with the S&P 500, well, as you can see, the S&P 500 in this year is on a very strong uptrend. You can see it making higher highs and higher lows, as always said, and you can see the moving averages are sloping up. So there is a sign of a good uptrend. And although I expected a retracement to happen in the month of June, it did happen a little bit, though I wish it dropped a little bit more back to this resistance level, but it didn't happen. Rather, it just retraces back slightly to the 20 moving average, which is the one in red, and it moved back higher from there. And in the last trading day, 30th of June, there was a gap upwards. So what this means is that there could be a stronger momentum from there. Prices could go up even higher from here. Moving on with the Hang Seng Index. The Hang Seng Index, unfortunately, it was down and it is still on a downtrend, at least for this year. Right? Although previously I mentioned that there was a triangle pattern over here, but it just broken down and it's continue going down. So it seems like the Hang Seng is just gonna continue to go down until there are stronger signs of reversal happening. Moving on to the Singapore Straits Times Index. As always, Singapore Straits Times Index is always on a very tight consolidation pattern, but you could notice there is some sort of triangle that's forming over here. So once the market has determined a new direction, it could go down or go up from there. But anyhow, Singapore is still always stable for a good dividend play. At home at FBN KLCI, unfortunately, is getting worse. As you can see from the moving averages, it has formed a downtrend for a while. And in June, the last trading day, it made a very strong bearish candlestick. And it has reached this support level, which has been tested a few times already in this month. So sadly to say that just looking at price action, the FBN KLCI could be going down even further from there. Not just the local stock market, another sad thing for the Malaysian front will be Forex. As I've mentioned last month as well, Forex has been relatively poor for the ringgit against most of the major currencies. For the main three currencies that I'm looking at, which is US dollar, Hong Kong dollar, and Singapore dollar, all of them have appreciated against the ringgit in this year. US dollar is up 6%, Hong Kong dollar is up 5.6%, Singapore dollar is up 5%. To put into perspective, the US dollar is now 4.66, Singapore dollar is now 3.45, Hong Kong dollar is now 0.595. All of these are pretty much new highs. So it's very hard for us if we want to invest in a foreign market. So I have not been doing any Forex transactions for a while. I mean, I don't trade Forex, but I have not been converting my ringgit into all these currencies to do my investing because it's very painful to just change them at their highest points. Because these currencies might normalize eventually, especially when the US Fed decided to lower down its interest rate in the future. So what has been the most important thing throughout the past 2 years, I would say, it will be inflation and interest rates. One reason that the stock market has been falling in last year because inflation was super high and the US Fed has increased the interest rates too fast. But inflation seems like it's gonna slow down and it has been slowing down ever since the June of 2022 from a high of 9% to eventually 4% in May. So that is a good news for the US economy and the US stock market. That's why stocks has been increasing like mad because inflation has been slowing down and confidence in the economy has improved. And previously, we have seen the Fed saying that they will temporarily pause interest rate hike for now, as inflation has been slowing down. Another point to note is that the US unemployment rate is all-time low at 3.7%. So the economy is very strong. So if you have seen news reports that say a recession is coming in 2023, it has been half a year. So where is the recession? There is no recession that's gonna happen, at least for now. There's no signs to say that a recession is coming. Things are better than it looks. So where do we go from here? Well, speaking of the Federal Reserve, their next meeting is on the July 25 to 26, but likely we won't see any interest rate hikes from here. So interest rate has been pretty much stabilized already. But who knows, anything can happen. If they suddenly increase interest rates again, when they say they won't, then we will see some dip in the stock market. And if that happens, then it's a good time to buy again because prices are cheaper. But if that doesn't happen, then the stock market could just go up from there. Though I wish the stock market could just drop a little bit more so that I can start buying again because I have put aside some cash since the end of last year that I didn't use it this year. But if it doesn't, then I just gonna buy at higher prices. So overall, 2023 has been a good year for the US stock market. If you have been investing in it, hope that your returns are good as well. For the other stock markets, unfortunately, there is no strong signs of growing in this year. Personally, I have some holdings in Hong Kong shares as well, and they are not doing well. But all my Hong Kong losses have been covered by my US gains. So yeah, so US is still the place to invest your money in, but that doesn't mean you should buy now because things are super expensive and Forex are not in our favor. So see whether you want to take the risk to invest right now. And ultimately, it's your decision, so you should be self-responsible for your own money. Alright, this has been a relatively quick review on the first half of the year. Hopefully, second half will be even better from here. And with that, I will see you in the next review.